thanks for joining me today and welcome back to my channel. If you're new here, I'm Antonia. I run Abacus Jack with my business partner Andy, and our mission is to help small business owners get confident by increasing their financial knowledge of their business and breaking down barriers so that you feel comfortable using the tools to manage your business and achieve financial success. Whether you're an experienced business owner or a startup, or just considering starting a business or a side hustle, we want to help you understand the stuff that they never taught you, but they expect you to be able to understand. In this video, I'm excited to share what you need to know if you're starting a business. In the last week, I've had lots of people get in touch with me and say, Antonia, please can I have a chat because I've just created a company, or I've just started, or I'm just thinking about, and I don't know how it works. How do I pay myself? What do I need to do? So I thought there's got to be more people like this. So I just thought a quick video would help get everyone going if they needed to understand the basics of getting started. Today, I'm going to talk about how to set up a limited company and kind of how to structure it with directors and shares, how to run the company well, what corporation tax is and how that affects companies, and how to pay yourself from the company if you're a director or a shareholder. If you have any more questions or need further advice, then that's fine. Just look at my links in the description. You can get in touch with me directly or send me a message. And I also have other videos on YouTube for you to have a look at. Alternatively, you can also follow us on Instagram, and we have lots of tax tips and information on Instagram to get you started as well. So if you want to create a limited company, there's a few things that you need to think about in terms of the structure. The first thing is going to be who controls the company. Someone who controls the company can be known as a director or a person of significant control. Normally, you need at least one director, someone who is the PSC, so they have the most control, and you also need a secretary for the business as well. That can all be fulfilled by one person, but you can also have multiple directors depending on who's going to be working in the business and who controls the business or different parts of the business. Next, you need to think about how the shares are going to be split up. So shares are what the company is owned by. So what you need to think about there is what's the ownership structure of the business going to be. So for example, some people might put money in at the start of the business or be the founder, so they want more of a shareholding. Other people might just want a director role, so they get better benefits in their salary, so they don't have any shares. Or you might have multiple shareholders. Sometimes if you have a husband and wife set it up, then you might have a 50-50 split. Or you can also split it in different ways. So if there's 3 shareholders, you can split it 3 ways. You can split it unevenly. And finally, what you can also do is you can create different share classes. So for example, if you have a husband and wife want to set up a company, both want to be directors and shareholders, but husband has already got a job, then you can make 2 classes of shares, class A and class B shares. And that means that when you vote dividends, you can issue them at different rates depending on the different classes of shares that you've got. If you only have one share class, then dividends have to be split evenly between the shareholders depending on the amount of shares that they hold. So if you have a 50-50 split, so you have 100 shares issued for the company, Director 1 has 50, Director 2 has 50, then you issue a £1,000 dividend from the company's profits, then they each get £500 each. If you have a company set up where Director 1 owes 60% and Director 2 owes 40%, then Director 1 gets £600 and Director 2 gets £400. If you have the situation where Director 1 has 50 Class A shares and Director 2 has 50 Class B shares, then Director A gets the full £1,000 when you vote the dividend, and Director 2, who has the Class B shares, gets whatever you've set up when you set the company up in terms of the rules. Maybe they get an annual dividend or a quarterly dividend or 50% of what the Class A is getting. It's all up to you what you start out with. So normally you set the directors and the shareholding up when you incorporate the business. So you also need to find a business name that's not taken already. You can do that by searching Companies House. So once you've agreed the directors, the shareholding and the name, then you can come to an accountant, or you can get an online incorporation service, or go directly with Companies House and you can incorporate the business. Once you've incorporated the business, Companies House will tell HMRC that a new business has been created and it's going to start trading. So HMRC will then think about sending a tax reference to you on a letter to the registered office address. Now, your registered office can be a virtual office, or it can be your home address, or it can be where the business is going to operate from. So when you get your tax reference from HMRC, that's the corporation tax reference that you're going to need going forward for the lifetime of this business. So keep that one very safe. Once the company's incorporated, Companies House will send you a pack of information, and it'll have some articles, and this will be where it describes how many shares you've got, who the directors are, and what the rules are around dividends based on what you provided at the start. It will also give you your company number, which you might need when you need to go and get a business bank account. So that's the second thing that you do. So you've created the company, you now have this legal shell that's separate to you as an individual. You now need to go and get a business bank account for it so that you keep the business money separate to the personal money. Now is a good time to look at your business plan if you've created one, or if not, start to do some budgeting for what you think you can expect to earn based on the sales that you're going to get. So if you have some clients in mind that you know are going to come and buy from you straight away, then that's great. You might want to estimate your sales across the next 6 months. And from that, you can also estimate your expenses, which might be things like mobile phone costs, direct costs such as materials that you need to make to sell the product that you're selling, advertising costs, office costs, just to get you going, things like your laptop, if you need any desks, that kind of thing. And from there, you can try and work out, are you going to have any profit or not? If you're going to have some profit, then you can start to think about, how do I take money back out of the business to get paid for me? So you can take money out of the business as a director in 2 ways. The first is you can distribute the profits. So if you say it's month 6 and we have £10,000 worth of profits that we've created and we still have cash in the bank account, then you can distribute that between shareholders as dividends. Dividends are then taxed through self-assessment. So you have to save tax in your personal account to be ready for that payment that'll be due the following January. The other way to take money out of the business as a director is to set up a payroll scheme for the company. To do that, you'll need to register with HMRC for Pay As You Earn. HMRC will then send you a letter with references in, and that's what you need to be able to start running payroll. From there, you can use some software like Free Agent or Xero to set up your payroll scheme and report earnings to HMRC about what salary you're declaring for each director each month. So if you just wanted to take a standard tax-free salary, you could take $1,047 a month each, and you report that on your pay slip, and that goes to HMRC and says that you've earned that money. If you have the cash to pay that money to yourself, then you can take that out of the business bank account and transfer it to your personal account. If you don't have the money, then that's okay, because then that sits as a liability on the company, so it owes you that money tax-free whenever it can afford to pay you in cash. When the company owes the directors something, that means that there's a director's loan liability for the director, and that means when you repay yourself from the bank account, if you have a director's loan liability on the balance sheet, you can take that money out tax-free back to yourself to repay yourself for business expenses. This is also true if you have to put money into the business account to start the business. So say you incorporate your company, you put £10,000 in the business bank account, that sits in your director's loan account until you take that back, because that money is going to be used on business expenses, but the company didn't earn it. You gave it as a personal loan, so the company has to pay it back. The other thing you need to be aware of is corporation tax. So you start trading, you have a business plan, it goes well, you make £10,000 of profit in 6 months. Hopefully your bookkeeping software like Free Agent will tell you roughly how much corporation tax you're going to owe. If it doesn't, then take 20% of that number and create a savings account for the business account and skim off the potential corporation tax money and put it to one side, because you might need that going forwards. Corporation tax is taxed between 19 and 25%. It will depend on the level of profits that you achieve, how much tax you have to pay. So you won't know until you get to your year end, but if you've saved 20% tax consistently on your profits, then you'll not be too far away. Some other best practice tips for the company will be, so you're running the company, you get a good system, get like a Xero or a Free Agent, and you start issuing sales invoices from your bookkeeping system. Next, you have a business bank account and you connect that up using the bank feed to your bookkeeping system so it captures all of the business spend in the business bank account. And then you also keep all of your financial records and you upload them to your bookkeeping system on a monthly basis so that when it gets to the year end, you haven't lost anything and it doesn't take you a ton of time to put everything together. At the end of each month, you review what's happened, you check your cash balance, make sure you have enough money for upcoming bills that you're going to have to pay. If you have a profit, you make sure you skim the tax off. If you have any creditors, such as the pay as you earn or the VAT. So sometimes if you take that 1,047 salary, it can create like a £40 employer national insurance bill to pay as you earn. That's due by the 22nd of the next month. So you want to set up a direct debit with HMRC. So make sure that you have enough cash to pay that. And if you have any VAT bills coming up because your turnover has gone over 90,000, then make sure that you're not just skimming for your corporation tax, but you're also skimming for your VAT payment as well. When you get your corporation tax reference for the company, it's also a good idea to start adding your taxes into that account because HMRC is a bit of an old-fashioned system and you kind of have to help it along. It doesn't do everything automatically for you. So if you set up a pay-as-you-earn scheme for your company, then you need to log into your government gateway account for the corporation tax reference that you got and for the company that you have, and you need to add pay-as-you-earn as a tax and put your references in and actually pull pay as you earn into your government gateway so that you can see what you owe and also sign up for direct debits. That's the same for income tax as well. And you also have to check that you have access to your corporation tax too, because as a business owner, you need to make sure that your taxes are up to date. Otherwise, HMRC will start sending debt collectors letters out to you, and that is not a fun experience either. So that's the basics of setting up a company and some things to get started with. If that was helpful, please give me a thumbs up. If you have any questions and you want to leave a comment or get in touch with me directly, then that's fine as well. I really appreciate your time today. Thanks for joining me, and I'll see you next time for more small business tips and tax advice.